Welcome to another episode of the Monday Mortgage Melt. Can you believe that this is the 50th week on the trot that I've been doing this live? Nice big milestone. Although we're going to have like another really big milestone in 2 weeks' time, because then it will be a year, 52 weeks. But slight different surroundings today. My wife and I are house sitting for Emily's aunt. So we are in Droitwich over in Worcestershire. Joseph, good to see you. Said, nice to have you on board. Mansyard, good to have you on board as well. So I was, because they have a really nice big house, I was planning to do this live from the hot tub, which would have maybe not been the nicest thing for you all to see, but the weather, unfortunately, has put pay to that, and it means that I am still inside. It's absolutely pouring it down, so I didn't think that doing a live video in a hot tub outside when it was pissing down with rain was going to be the best thing to do. So maybe you've got away with that. You don't have to see see me with no top on sitting in a hot tub. But thank you so much for jumping on today. As I said, this is the 50th episode on the trot where we're doing the live Q&A. So for those of you that haven't been on live before, this is the Monday Mortgage Melt. And on this wonderfully titled live Q&A every single week, what we do is answer your property finance questions. So what you might be thinking is, that's all well and good, mate, but who are you and why should I listen to whatever the hell you're going to tell me about? Well, my name's Sam. I am the owner and director of Grand Union Finance, which is a specialist mortgage brokerage or property finance brokerage based in London and the West Midlands. And our job basically is to service the property investor part of the industry. We look after investors and developers. We arrange finance for them. And from everything from kind of like more specialist buy-to-let mortgages, HMO mortgages, mortgages for holiday let, serviced accommodation, social housing, anything you can think of really. Obviously commercial property as well. We also do a lot of bridging finance and a lot of development finance. So if you've got any questions surrounding any of these types of financial products, or to be honest with you, anything to do with property, the property market, I am more than happy to help out and I'll answer all any questions that you may have. So a little bit of housekeeping, I guess, is lots of people try and use the comment section to put questions. That's great, but it's really, really hard. When obviously lots of people are joining the live, as you can see, people's names are starting to sort of pop up. I lose those questions in the comments. If you look down here, you will see that there's a little question mark box. If you click on that and type in any questions you've got in there, I will very, very easily and quickly be able to click on that, bring them up on the screen so everyone can see them, and then I will be able to answer those questions. And when people are joining, they'll be able to see that question down at the bottom as well, and I won't get your question lost in the comments. Obviously, as I'm rambling on, if you guys have got any questions, any sort of comments on the whatever I'm talking about, whatever questions we're discussing, whatever topics we're discussing, obviously leave them in the comments. Let's get a little group discussion going on here. Thanks for all the likes, guys, and hello to everyone that's waving back to me. Did you know, actually, the more that you click on that the little heart button, the more the Instagram notifies other people that this live is going on? Didn't know that. So if you all just want to smash the heart as often as you possibly can throughout this, that will actually help me get more people on and get more questions, and it should be a much more informative and helpful little live video for the lot of you. So before we get into any questions that pop up, thank you so much everyone for liking this video so much. So just to give you, I guess, a little bit of an update on what's going on in the finance market at the moment. Somebody actually asked me last week on the live to give sort of a buy-to-let mortgage update, and I kind of did a very, very quick version of that. But I think it's really, really interesting to see that there's a little trend going on, which the uninitiated might not know why this is happening. So a lot of mortgage lenders, and also, to be honest, a little bit in terms of bridging lenders and development finance lenders as well, they're doing so. Let me take a step back. When lenders want to get more business, so more applications, they do one of three things, or a combination of three things. They're going to decrease their interest rates, obviously. They're going to increase their maximum loan to values, and they're going to make their criteria more flexible. Okay, so lenders have been doing a combination of those three things in droves over the last few weeks. We as brokers get emails from lenders, specifically mortgage lenders more so, giving us updates on changes to products, and we have been absolutely flooded with those emails over the last couple of weeks, with lenders basically reducing their rates, increasing loan to values, changing criteria to make it more easier. Now you might be thinking, this is all well and good, Sam, thanks for the update, but what's the point of all of this? Why are you telling us this? Well, if lenders, bearing in mind how buoyant the market has been, we've seen like record numbers of transactions, record numbers of lending, record numbers of, or record highs in terms of property values, everything like that. The market has been insane, and everyone's been sort of talking about this dip in the market that's going to be coming. Well, a good indication that dip may be on its way is that lenders who are very, very clever, they've got huge analytical stats people behind them that are doing lots of research into the market so that they can be one step ahead of what's going on in the property market. They are probably telling the product developers, you need to be getting in more deals, because competition is going to be tougher towards the back end of this year, because we're expecting transaction numbers to go down. And that's why they've started to release these products that are enticing more business. They're being more competitive because they know that competition is going to go up towards the back end of this year, because lenders are predicting a dip. So that's the greatest indication so far that we are headed for a dip in the property market, because lenders are being more competitive in their products. So really, really good way of determining what's going on in the property market is to actually see what lenders are doing with their products. And to be honest, bridging lenders and development finance lenders are following suit as well. I'm definitely seeing the cheapest sort of bridging from my favoured lenders, and my favoured lenders tend to be the ones that offer great service and speed. Price is important, but getting the job done is the most important thing when it comes to bridging. So we tend to go for sort of, we don't go to banks for bridging because it takes longer than getting a mortgage, to be honest with you. But I'm even seeing from sort of the lenders that we use more frequently, their rates are coming down. We've got development finance for a brand new investor at 0.69% a month the other day, which was absolutely insane, really, really awesome. So yeah, the market is changing really for the positive, which is really, really good. But let me, we've got some questions coming in. So let's jump straight into some questions then, because this is the reason that you're all on. So, Said has put a really, really long question in there. So let me read this out first, because I don't think all of it is going to fit on the page. I'm thinking of buying a leasehold house, which is quite unusual. It has a 3,000-year lease and a £10 per annum ground rent, no service charge. Is there any disadvantages to buying a leasehold property as opposed to a freehold property? Okay, well, just let's give it sort of a 3,000. Is it 3,000 foot view? Is that the terminology? Talk about this. So in terms of leasehold versus freehold. So from a lender's perspective, the only real reason why they would prefer a freehold over a leasehold, and we're talking about a freehold house and then a leasehold flat, a combination of each of those is a slightly different thing altogether. But talking about the freehold house versus leasehold, the only reason they're going to prefer a freehold over a leasehold is if the lease is particularly short. Most lenders like to see that there's 30 to 40 years left on the lease at the end of your mortgage term. So if your mortgage term is 30 years, then they'll want your lease to be at least 60. However, there are some lenders as well that actually have it written into their criteria that they won't accept anything less than 60. And there's quite a few bridging lenders as well that won't accept anything less than 60, unless you are looking at, I think, is it Section 42 agreement in place to extend the lease. So you can actually reassign a Section 42 agreement on completion that has been drawn up between the freeholder and the leaseholder that you're buying the property from, that can be reassigned to you. You can extend the lease on completion, basically. And lenders are okay with that. Now, with what you've just put up there, Said, is the is the fact, I mean, I've never seen a lease that long. So there's obviously a reason for that. I don't think that's going to put a lender off, so that's fine. The £10 per annum ground rent, amazing, no service charge, fantastic. I would probably do some digging in on the lease or that, because it is really unusual. There might be some other quirks in there that aren't as positive. You've listed a lot of the positive ones, but there might not be. There might be some quirks in there that are not that positive. So have a look through it. Check out things like, is there a written in review of the ground rent or service charge after a certain time? Is there a sort of a change to that? So say that after 10 years, suddenly they will be able to charge a service charge and it's going to be really high or something like that. So check out those kinds of things, because it does sound a bit odd. Also, if the property is a little bit weird in terms of its quirkiness or something like that, because if the lease is quirky, perhaps the property is quirky as well, and there are other things that you might just want to have a look at, that could mean that lending on that is a little bit difficult. So it's always more simple to get a mortgage or a bridge or whatever for a freehold property, to be honest with you, because you don't have the lease to worry about. And leases are actually pretty tricky things, because I mean, I've seen something recently whereby a client was complaining that his his service charge had gone up massively from 1 year to the next. And I said, have a look at the lease. Is there something written in there? And he found that actually it was written in that every 7 years, the service charge was going to go up by 50%. Now, as it turned out, his solicitor probably should have made him aware of this when he bought the property. But imagine what that's going to be like in like 50 years time. Okay, he might not have the property 50 years time, but when he comes to sell this property, that's going to still be written into the lease. And there's a lot of these things that are written into leases, and whatever's written into the lease, that's it. There's no comeback on that. There's no, I don't like the look of it. It's like, well, you shouldn't have bought it then. That's what the freeholder's going to say. So check in those things, particularly new build properties. They've got these kind of things. Yeah, service charge is X amount now, but actually in 5 years' time, it's going to go up by 25%. And then it's going to go up by 25% again another 5 years after that. This is quite normal. And if it's written into that lease, that's it. You could take them to court. It's not going to get thrown out. It's going to get thrown out. You don't have a leg to stand on. You signed the lease when you bought that property. So be really, really careful with when you're buying leasehold properties. It's why, to be honest with you, I reckon probably maybe not that much, maybe 80% of all my clientele, they buy freehold all the time. You don't have these problems. But there's a lot of positives about buying leasehold properties as well. As I was saying earlier on about the sort of the lease extension, I had a client, and I've talked about this before, so I won't go into too much detail on the story. But one of the most annoying cases I ever worked on was actually for a leasehold purchase where the lease was only 8 years remaining, which gave it an incredibly low value. Now, the Section 42 agreement to extend the lease back to 99 years was in place, and it could be reassigned on completion. I actually managed to arrange a bridging loan or a type of bridging loan where the lender was going to lend 70% towards the purchase price and 100% of the cost of the extension cost, which was 350,000. They're buying for 400,000, so 750 all in. When the lease had been extended to 99 years, this flat was going to be worth in excess of 1.4 million. Okay, so instantly, so much equity being created in such a short space of time. Unfortunately, the client at the time did not want to extend the lease. I have no idea why, and I've never spoken to them since, to be quite honest with you. But yeah, a really, really odd situation. But there are things you can do to add value to a leasehold property by improving the quality of the lease. So that is something that you can look at. But thanks ever so much for your questions, Sadie. I will move on to the next question. By the way, guys, thanks ever so much for everyone that's joining. Give me the love. Keep hitting the heart button. It keeps telling everyone that we're live and we can get lots of people to come and join in. If you've got questions, a little bit of housekeeping, as I've said it before, chuck them in the question box down here, because hi Richard, good to see you, because I will then be able to bring the bring the question up on the screen for everyone else to see. If you've got any comments, you want to say hi, anything like that, drop them in the comments. Any questions, put them in the question box, because then we can get them in front of everyone else. Cool. So yeah, keep hitting the like button. So next question is from Joseph. It says, hi, I have a question regarding CCJ. Thanks. Have badly affected on my mortgage. Thank you. Okay, cool. So we're talking about adverse credit here. And I actually had to have a difficult conversation with a client on Friday whose credit file unfortunately wasn't good enough to be able to achieve a mortgage, which is really frustrating. So credit files, they are a bit of a difficult thing to talk about a lot of the time, because you can damage a credit file like that. And that was a really poor finger click. I'm better with my other hand. So you can damage a credit file literally overnight, and then it takes years to repair. It's a little bit like breaking your leg, a credit file. It takes 2 seconds to break your leg, and then you're in a cast for months afterwards. And it's exactly the same with a credit file. So any damage that you do, any missed payments, any defaults, any CCJs, they stay on your record for a long time. And lenders will have a lot of the time very specific criteria surrounding how many defaults, how many missed payments, how many CCJs, whatever, are allowed within a certain period of time. And some lenders will even have different products for varying degrees of poor or adverse credit. So if you have had a CCJ, number one, if you've got anything on your credit file that's like a default, a missed payment, a CCJ, like, get it up to date ASAP. Just get it satisfied. Even if you disagree with it, even if it's not fair, whatever, just freaking pay it as quickly as you possibly can. Then fight it, because you can't undo the fact that you haven't paid something. If something is showing as being owed, you can put notes on it, stuff like that. Lenders aren't really going to take much notice. All they're going to see is you had an outstanding default and you didn't pay it back for 2 months, 3 months, 4 months, whatever it might be. Just pay it. So the amount of times that I see clients with defaults registered against their name for not paying their broadband bill, that's like 28 quid, and then just leaving it for 6 months. That's ridiculous. Just pay it. Just pay it off as quickly as you possibly can. Everything is paid, but the CCJ done 2 years ago. Exactly. So this is what I was going to come on for. So number one, pay it off ASAP. Satisfy it as soon as you possibly can, because then the clock starts on your satisfied date. As we go through the years, 1 year, 2 year, 3 years, 4 years, the lenders aren't looking at how much. The lenders aren't looking at when you did the default or when you had the CCJ. They're looking for the date of when it was satisfied, and they will start the clock on their criteria on that. So lots of lenders will say, right, okay, we won't accept any satisfied defaults or CCJs within the last 36 months, something like that. So last 3 years, they will not accept it. Or they might then have another product that's a bit more expensive that says we won't allow within the last 48 months or the last 24 months or the last not the last 48, the last 24, the last 12 months. And they might have staggered products that allow for, varying degrees of adverse credit. But basically, as I said, get it satisfied as quickly as possible, then the clock starts. There are also lenders that will ignore certain CCJs or defaults or missed payments if they are for something that's below a certain amount. So, for example, we did some research last week on a client that had some missed payments, had a default, but because the amount that it was registered for was less than £250, not 250,000, that's ridiculous, £250, the lender could ignore it, and it didn't fall into their adverse credit criteria, which means that we could just access their normal products. So it is really, really important to get it satisfied as quickly as possible. But if they are relatively low valued, actually the amount that it's outstanding for is quite important as well. So only £300 parking fine. £300 would fall above that 250, so it would be seen as a significant amount. So chances are, Joseph, you are going to struggle with that for a little while. There are lenders out there that can offer you mortgages, but you are going to be paying more than what some of the other people on this live are likely to pay, unfortunately. Good question, Benny's. Low value is going to be 250 and below, basically. So if your default is less than £250, there is going to be more lenders out there that can just disregard it and not actually put it as part of their adverse credit criteria. If it's above that, chances are it is going to be included. And then of course it's just, like I said, it's just down to how many years outstanding it is. It's a real it's really annoying. We ask every single one of our clients to send us a credit report, because the thing is as well with credit reports is they're actually pretty confusing. I've been looking at credit reports all my life. When I came out of university, actually, I had really shit credit, like really, really shit credit. I'm up to 997 now. I'm a bit pissed off that I haven't got those last 2 points, which is really annoying. But anyway, I'm up to 997 now. So I've actually got personal experience of improving a credit file. I know what improves a credit file. I know the little tips and tricks on how to do that. In fact, I think I might have done a live video recently or a post recently all about how to improve your credit file. Maybe I'll do a YouTube video. If that'll be handy, just put like a thumbs up in the comments if you think I should do a YouTube video on how to improve your credit file. I know it's a bit niche, probably not be my most popular video ever, but if it's going to help you guys, I'm more than happy to do it. So there's so many things that you can do to improve your credit file. It's really difficult to understand it, which is why, we ask clients, send us a copy of your credit file. I will review it before we do anything. And I've taught Ruby really well, who's just given me a 3 thumbs up because she knows how important it is. I've taught Ruby what to look out for on credit files as well. It's really, really important to understand exactly how those credit files work. It's incredible. So cool. Let's stop talking about negative things. Let's try and see if we can find a nice positive question. What's Benny said, it's crazy, but you could still have ACE credit and still be declined. Absolutely. Do you know what? I've had clients that have got really, really good credit scores have been declined, and clients have got low credit scores and haven't been declined. So it's it's not an exact science, unfortunately. The thing is with credit scores is lenders don't actually see them. I did a reel about this recently that was pretty popular. Big top secret about credit scores. No one sees them other than you and the credit agency. When you apply for a loan or a credit card or a mortgage, the lender or provider doesn't see your credit score. They just get information from your file, your report, and they will generate their own internal credit scoring system. Their internal credit score as part of their system, and they will decide based on that whether they're going to lend to you or not, or whether they're going to give you the loan or the credit card or whatever that you want. So it definitely is the conduct, not the score. So what's on your file is more important than what the score is, because the score's a good indication of how strong your credit file is. It's not the be all and end all though. Okay, so don't get too concerned about that. Let's see if we can find another question that's this is great. I don't know if this is if GP Hill is having a little joke with me because of the reel that I did last week, which made my wife very happy because I did it was a voiceover. You see the reels that people do where they're like voiceover ones, and you sort of do lip syncs to them. It was a quote from The Little Mermaid, and it was Ursula the sea witch or whatever it is, and it was sort of a bit of a joke on this question. So GP, I don't know if you saw, or G Phil, maybe it's G Phil, GP Hill, G Phil 79. I don't know if you saw this reel and that's why you're asking the question, but do you deal in commercial mortgages and bridging? Yes, absolutely. So that is actually what Grand Union Finance do, although I have just so what I've realized is I want to be able to help as many people as possible. Whenever I get a residential mortgage inquiry, it sort of dilutes my time into doing that, when really I want to be focusing all of my attention on my investor and developer clients. So we've offered a contract recently to a new special broker. Go check it out. Go and have a look at my reel. That hopefully make you laugh. That's the whole point of it. But yeah, offered a contract to a new broker who's hopefully going to come on. Don't forget to know the names in Little Mermaid. I can't, TJ, I have to know because my wife is Disney obsessed. I have to know everything. I think I know all the words to Moana from back to front, and probably Frozen, and what's the one with Rapunzel on it? Tangled. Yeah, I know that one too. Emily watches them all the time. But there we go. Yeah, I was going back to talk about, so offered a contract to a residential broker recently who is going to come on board and basically just look after all of the residential inquiries that we get, because it would be good to have somebody that has that specialization to help with our help with our clients that need that advice, and I can then focus purely on the more commercial side of it. So I kind of sort of see it as we split the company into residential versus commercial, but what comes under commercial actually can be sort of just the more complex stuff. So not just commercial mortgages for commercial property, but also things like bridging finance, development finance, the more complex type of mortgages. Because I mean, we've done two mortgage applications in the last month, two commercial mortgage applications in the last month that are just for they're actually for residential properties. But because the criteria is so strict with residential mortgages, when I say residential, I'm talking about buy to let as well. It's sometimes impossible to get mortgages for these properties in the residential part of the market. You need to go into commercial. So by the way, guys, if you're dropping questions in the comments, please drop them in the question box, just because we'll probably lose that question by the time I finished answering this one. But in answer to your question, GP, yes, we do deal with commercial mortgages and bridging. That's really where the specialisation is. It's funny, actually, I was talking to somebody recently about the mortgage market as a whole in terms of getting broker advice. And really, to be honest with you, 80 to 90% of all mortgage brokers out there are your old traditional residential mortgage brokers. And they deal really with relatively straightforward type of cases, and I actually think that the market for specialist knowledge, that actually where you can help people with more complicated circumstances, particularly property investors, it's not that big a part of the market. I think it's growing, but it's still not where it needs to be. And unfortunately, so to give you some insight into this, anything where you're looking for an investment finance, so whether it be a buy-to-let mortgage, a bridging loan, a development finance loan, commercial mortgages, none of these loans fall under the regulation of the FCA. They fall under the regulation of the PRA, which is the Prudential Regulatory Authority. Now, theoretically, you don't have to be a qualified mortgage broker, i.e. you don't have to have your CMAP exam, which is your Certificate of Mortgage Advice and Practice, in order to give advice on this stuff. And what that means is that there are a lot of old school lenders, Richard will know this because he works in this space, there are a lot of old school lenders on bridging, put my teeth back in, a lot of old school brokers that are used to sort of dealing in a really unregulated type of market, and they won't necessarily be able to give, I personally think, the level of advice that you need. They're kind of more just introducers of business to different lenders, and I think that it's really, really important to find brokers that deal in the specialist space but have the CMAP qualification. I think that's really key, because they can give you very, very detailed advice about not only regulated mortgages, but also a lot of the regulation or a lot of the sort of the criteria and stuff for buy-to-let mortgages does reflect the market, the residential mortgage market, and exit strategies to your finances is the most important thing. And if you're going to take out a bridging loan, development finance loan, you need to be able to know how you're going to repay that. And I think a lot of the time, unfortunately, if you're not regulated, or you're not regulated by the FCA, or you're not sort of have that level of mortgage experience, sometimes the exit strategy is not deemed to have been as important. And a lot of brokers, I think, because I get this feedback from lenders, they're not as clear when it comes to the exit strategy as maybe they should be. The regulation stipulates that you need to highlight what the exit strategy is going to be, but you don't necessarily need to prove it. Now, I like to prove it. I like to actually speak to my clients and go, right, okay, we're going to do this bridging loan because you're going to buy this property, you're going to renovate it, and then the idea is we're going to refinance it based on a higher or uplifted value, and we're going to be able to recycle our cash. Now, to make that whole thing work, we need to know that you can get a buy-to-let mortgage. So you need to look at the kinds of things that buy-to-let mortgage lenders require. Is there going to be a minimum income requirement? Do you have an income? Where does your income come from? What kind of rental income are we looking to generate on the back end? Is that going to be enough to fit within a standard rental calculator to allow you to borrow 75% of the new loan? So what's the point if you can't? is the property of non-standard construction? Are we going to be limited to certain lenders as a result of that? There's an endless list of things that we would need to check in on before before we can make a determination as to whether or not there's actually going to be an option to refinance this property at the back end. So it's why it's so important to work with brokers that really do understand this whole part of the market. Guys, if you've got questions, please drop them in the question box below, just because I'm going to lose them if they're in the comments. But if you just got comments, then I'll have a little look. I think these are questions. Chuck them in the question box, because if you click it's just down here on the side. It just means I can bring them up on the screen, then everyone can see them. So yeah, I'll talk less about mortgage brokers and start talking more about other stuff. So next question, Temi has asked, is it possible to buy another house within a year of buying my council flat? So this is a really, really good question, Temi. I got asked this question recently, actually. So my understanding is that there will be written into your contract. So if you're talking about the right to buy, so the right to buy means that you can't make any changes, I don't think, to the property that you're buying within a certain period of time. I was talking to a client recently, and they seem to believe that they would be able to actually rent their property out if they got consent to let in 6 months' time after they actually bought their property through the right to buy scheme, but they weren't permitted to sell the property within a certain time frame without incurring a penalty. There was nothing written in there to say that you can't buy another property, I don't think, in that particular one. Looks like Richard's come up with 5 years. Richard, is that saying that the 5 years is you can't buy any other property? Is that residential property within 5 years' time? Because if you actually convert the right to buy property onto a buy-to-let mortgage, if you refinance onto a buy-to-let mortgage within a certain period of time, then technically I would imagine you'd be able to buy another home for yourself. But that's a really, really good question, Temi. So my understanding is any limitations will be written into the contract that you will get from the local council as part of your right to buy application. So it can potentially have a negative impact on your ability to grow a property portfolio if there are limitations in there. Now, I would think it would be incredibly problematic. You can't capital raise or sell for 5 years. There we go. Perfect. So that limitation is on the property itself, not on the property that you're going to be buying in the future. So unless there is something very, very specific in the contract, so you can't go out and buy other properties, then you're all good to go. Basically, you're able to buy other property. What you can't do is you can't capital raise or you can't sell the property within a certain period of time. Because obviously you could buy the property at, say, I don't know, 25% discount, get a 75% loan to value mortgage, which will be based on the actual open market value rather than the purchase price. You can't do that just for standard purchases, by the way, with a mortgage. It has to be right to buy. And then you could you could wait for, I don't know, 6 months and then capital raise on it and basically pull money out of it when you're making profit on that too quickly. And that sort of goes against the whole point of the right to buy scheme. It's there to help people purchase their home, it's not to make a quick buck, basically. So thanks very much for your assistance, Richard, with that. Hopefully, Temi, that answered your question. When you do speak to your local council, make sure when they send you through the details, there isn't anything written in there that would basically wouldn't allow you to buy any other property. And thanks for the assistance from those in the audience. So let's get on with the next question. Nick has asked, can you borrow the purchase amount plus refurb costs on a BRR deal to let on a BRR buy to let deal? Cool. Great question, because this opens up actually a few different things that we could discuss. Okay, so here we're talking about, can you borrow the purchase price and the refurb costs? Right. So this is going to be dependent on a few different things, Nick. So number one, let's talk about open market value bridging. Okay. So open market value bridging is a bridging loan that is lent against the as a percentage of the current open market value, not the purchase price. So let's say, for example, that the purchase price was 70,000. I'm just using easy numbers here. The purchase price was 70,000, but the open market value was 100,000. So theoretically, a lender, if they were lending you 70% loan to value, could lend you 70,000, and that would allow you to borrow 100% of the purchase price. Now, if the costs were of the refurb were 10 grand, then you would need your open market value to be substantially higher to allow 70% to include the purchase price and the cost of the works. So that's how you would do that. The other way of doing it, as Bernice has written down below, development bridging, we call it refurbishment bridges or refurb bridges. There are some lenders out there that can lend a higher loan to value against the purchase price. So we're not covering the purchase price and the refurb work, we're covering a higher loan to value percentage. Now, theoretically, we would be looking at, maximum really is probably 90% loan to value on the purchase price, but you're starting to pay like 1.25% a month on that kind of stuff, which is really, really, really expensive. But if we limit it to 85%, theoretically, what they're doing there is they're lending you 75% against the purchase plus 10% towards the cost of the works. So as long as you've got a bit of refurb experience, then we can look at getting those kind of loans, and they start around 0.85% a month instead of 1.25, which you get at 90. So that's really, really good. So that's another way of doing it. The other way, which is kind of, I guess, an alteration on the open market value bridging, is you may well have heard of and this happens really more on flips, to be honest, rather than refurb and holds. You might have heard the terminology or the strategy, exchange with delayed completion. Now, what this basically is that you exchange on the purchase of a property that requires work, during which time, before completion, you actually go and enter the property, renovate it, and then complete once the work has finished. What we would do with bridging on that, which is, as I said, like a kind of an alternative way or a similar thing to open market value bridging, is we would get all of the application work underway, but we'd hold off on the valuation until the survey, until the work has been completed. Then what happens is the surveyor goes out and values the property at what the current open market value would be once the work has been complete, and they would lend based on that. So what this does mean is you're probably going to have to front up the cost of the works, because you're going to have to do that during the exchange and completion. But you could have that reimbursed to you pretty quickly once you complete, because the open market value hopefully will be high enough to allow to cover for those works and the cost of the purchase as well. That means then what you would do is you put the property back on the market pretty much straight away, sell it as quickly as you could, and then you take the profit basically. So it is a way of, yes, if you've got a bit of cash, you're going to need to put it down to cover the cost of the refurb, but you do need to find a good patient seller. A lot of the times, it's like when it's repossessions and properties that have been inherited that need to be sold quickly, whatever. It's usually those kind of things because the properties aren't inhabited. But yeah, you can do something like that. Like I said, that works really well on a flip rather than a BRR, because generally speaking, the more you borrow against the original purchase price, the less likely it's going to be that you can refinance it and pay everything off. So you really want to be looking at probably flipping those kinds of properties. For me, when you're financing BRRs versus flips, flips you can leverage pretty highly because you're selling them on, making your profit quickly. You're not dependent on 75% of the upward value as the amount of money that you're going to have at the back end to be able to pay everything off. So if you can leverage lower on the purchase price, they're going to be better for BRR deals. If you have to leverage higher, they're going to be better as flip deals, because that's the only way that you're going to be able to recycle your cash. So good to know on that. But hopefully that was helpful, Nick. So yeah, basically, long story short, yes, it is possible, but the open market, you're going to be having to look at pretty high below market value. So big difference on that. Right, next question. This is quite a long one, so I'll read this out first. So Sadat 1X has asked, looking at buying a 4-bed HMO property with currently 3 tenants already living there. I'm planning to stay in one of the rooms. Will I be able to get a first-time buyer residential mortgage? Quick answer to that is no. If you're not living in the majority of the property, I think it's something along the lines of you've got to be living in at least 60% of it. as being your complete domain, off the top of my head. Like I said, residential mortgages aren't exactly my 100% forte, but I know enough to understand this. So no, if you're buying it if you're buying an HMO, bearing in mind as well, if it's HMO, it's probably going to be a C4 classified property. So you won't be able to get a residential mortgage on a C4 classified property. It would have to be C3 classification. So you won't be able to do that. There might be, so I'm just wondering if there are HMO lenders out there that actually would allow you to live in one of them. I'm assuming there probably won't be. So no is the answer to that. I know what you're thinking of. You know those you see, like, it's like the whole rich dad poor dad things. Oh yeah, don't how to pay off your mortgage quickly? Buy a property, live in it, rent out the other rooms. That's when you do it like the other way round. So say for example you buy, I don't know, a 3-bedroom house, you live in one of them and you rent out the other 2 rooms after you've already moved in and you've got consent to let to do that. That's how you would do it. You wouldn't do it the other way around, because if it's already an HMO, it's probably going to be C4 classified, which means you won't get a residential mortgage. It's probably got an HMO license or registration on it, which means, again, you're not going to be able to get, you wouldn't even be able to get a buy-to-let mortgage on that. You'd have to get an HMO mortgage. HMO mortgages are unregulated. If you're going to live in a property, the mortgage will be regulated, so it means you won't be able to get one. So, yeah, unfortunately, you'd need to do it the other way round, basically, and just rent out those rooms once you'd already purchased the property and you'd had consent to let, or you had permission from the mortgage lender, which probably means you have to wait about 6 months before doing that. But it does work. I've got clients that do it. It's a great way of getting your mortgage paid off nice and quick, and you don't have to do anything. So would I be able to get an HMO mortgage as a first time buyer? As a quick follow-up question, yes, you would. If you don't own any property at all, you are going to be very, very limited. The last mortgage that we did for a first time buyer, first time HMO landlord, first time landlord, first time HMO landlord, was about 5.5% as an interest rate, and that is going to be on a fixed rate for about 5 years. The lending options are so limited on something like that. I reckon actually since then rates might have come down. You're probably just shy of 5%, but you're looking at a very, very high interest rate, which obviously is going to have a negative impact on your monthly net income and your net cash flow. But you've got to just work that into your figures. You know, if it's going to take if it means getting on the ladder, if it means buying a property, it means starting to get some cash flow. You know, in 2 years' time, you can refinance that onto a lower interest rate once you've had the property for a certain period of time. You built up your experience, and you'll be able to get probably a much lower interest rate. You know, standard HMO 2-year fixes for limited companies, 3.5%, 4%, somewhere in between those two figures, which is obviously a lot better than 5. So that's what you'd be looking at. Cool. I've seen we've had a few comments, so we'll go back and have a look. So Ixie said, what is the average interest rate on a BRR? So when we're looking at BRR, we're looking obviously at bridging finance to purchase the property with. And funny enough, somebody who asked me this question earlier on, it's kind of a how long's a piece of string type question, because there's so many variables that can impact the cost of bridging finance. So you could be looking, if you go to an institutional type banking type lender, where basically it's going to take you about 6 years to get a bridging loan, because their application process is so bloody long. You're looking, if you're only borrowing 50% loan to value, 60% loan to value, you might be looking at 0.5% a month, might be looking at 0.55% a month, something like that. Generally speaking, though, most of my clients require the balance of speed, flexibility, and price that the kind of middle order lenders offer. And realistically, if we're looking at 70 to 75% loan to value, so I'll explain what I mean by that sort of that balance. So I often talk about, and some of you might have heard me talk about before, the bridging or the finance triangle. Okay, so these are like 3 points on the triangle, and on one point you've got price, on one point you've got flexibility, and on another point you've got speed. And generally speaking, you're not going to get market leading on every single one of those points from one lender. So if you want the absolute, you've basically got to prioritize those 3 things. So if you are if you need to borrow a high loan to value, you need lenders that are flexible enough to lend you that high loan to value. So flexibility is therefore your most important part of that triangle. That's what you've got to focus in on. You've got to find lenders that are flexible enough, and then you start looking at the other two. Right? Is there a deadline that we need to work to? If there is speed actually more important than flexibility, and then speed needs to be the most important. But if there's a deadline, speed is at least the second after flexibility. Therefore, price actually is the third most important thing that we're looking at here, and it's important to grasp that, because I always get asked, how cheap can bridging finance be? It's like, well, actually, that's not the most relevant thing right now. What's relevant is those other 2 points. Flexibility could be a multitude of different things. It could be, will you lend on a property with less than 60 years left on the lease, as we were discussing earlier on? Do you lend to first-time investors? Do you lend to those that haven't got any refurb experience? There's all sorts of other sort of quirks and things that we need to look at. So flexibility might be your most important thing. Only when flexibility is not important, speed isn't important, does price become the most important thing. And then at those points, then sod it. If we've got no deadline, and you only want to borrow 60% or 65% loan to value, then great, let's go to Masthaven, UTB, these types of lenders that will probably lend some of the cheapest bridging finance on the market, because you don't have to worry about those other 2 things. These lenders aren't flexible. These lenders, their underwriting takes a long time. So speed, you wouldn't be able to use those kind of lenders for an auction purchase, for example. So when you're looking at what kind of finance you need for your BRR deal, the first thing you need to be looking at is that bridging triangle: speed, flexibility, and price. Which of those 3, put those in the order of priority that you need, and then that's what will determine what type of lender you need to go for. And then it's about approaching them to try and get the best possible terms that you can get. So I always talk to my clients, basically our process is, we do a bit of deal analysis just to make sure it works, but then we look at that bridging triangle. We talk about what's the most important part of that process. Often it's flexibility, if I'm honest with you, with a bit of speed chucked in. And then it's a case of, right, okay, so we know what lenders we're going to go for. We need to send them a proposal. We need to convince them that give them enough comfort to make them realize this is a really, really good proposition. They should really want to lend to you, and then we can kind of play off the lenders a little bit against each other. Generally speaking, what I will do is I'll pick the top 3 lenders that I think are going to be the best suited lenders for my client's particular transaction that we're looking at. Approach those 3 lenders. If I think the pricing I'm getting back from them isn't good enough, I might then go to sort of another few and just see if there's a way of getting some better pricing. But often I'll then sort of say to some of the lenders, because a lot of lenders, without sort of blowing too much smoke up my own arse, a lot of them sort of like the way that I do things, so they kind of give me preferential treatment sometimes, which is great. That just happens over time, and so I might go back to them and say, look, Mr. Lender A, Lender B has actually come back to us and given us this. So, and I kind of use the terms, so we're going to go with them on this in this occasion. They'll go, well, actually, we're happy to undercut them, and then you just get a couple of half a bip off or whatever it might be, and it just sweetens the deal a little bit. So there is a little bit of negotiation that goes into it, but generally then we get the terms. And the thing is, when we're sending these proposals over, they're pretty comprehensive. I'm not the kind of broker that just sends over any old crap to a lender, throws enough shit at the wall and hopes enough of it sticks, so to speak. We actually give them enough information. I actually reading an industry magazine recently, and there was a big article in there about how the thing that brokers hated the most was when bridging lenders changed the terms of the loan halfway through the application, and I was reading it thinking, yeah, this is the broker's fault. It's not the lender's fault. It's usually because something has come to light that should have been told to them at the very beginning. There's a problem with the lease. There's the construction of the property isn't what it should be. The client's got adverse credit, or I don't know, loads of different things. I'm just making stuff up off the top of my head. But if all of that information is not given at source, then of course the lender's well within their rights to change the terms of the agreement afterwards. Because I had one recently where the client didn't tell me that since this has happened, I now check every single property on Google Maps just to be on the safe side. They didn't tell me that it was next door to a chicken shop, and so the lenders come back and gone, we're not as comfortable with this anymore. We're going to limit the loan to value to 65% rather than 70. Great, look, that's fine. That information wasn't given to them at source. They were within their rights to change it. So it's really important to give a comprehensive account right at the very, very beginning of the process. I often say a couple of days extra at the beginning doing due diligence and organisation and getting all our ducks in a row is worth its weight in gold throughout the process, because you will make that back and double that time back. Because otherwise what happens is you then get into a war of attrition with the underwriter. Ask a question, answer it. Ask a question, answer it. Ask a question. It's just back and forth, back and forth. And instead of spending the usual 1 to 3 days doing the initial underwriting, which is what we aim for on every bridging application, it takes days and days and days and days. And all that does is it pushes back the time that you get the valuation instructed and the legals instructed. That's where bridging loans are done and not done. Is in the legals and the survey. The underwriting, we know what they're going to ask up front. So we basically know what is going to be asked. We know that it's going to go through. We know there's not going to be a problem. The thing that we can't determine all the time is whether there's a problem in legals, or whether there's going to be a problem with the property where the surveyor comes back and says, well, actually, there's this problem. I mean, we had one today where the surveyor noticed that the property was on a former coal mining area, so we've now got to do a mining report, which is going to add a little bit of a delay to the application. We wouldn't necessarily have known that in advance. I'm not going to be horrible to the client. They wouldn't have known that in advance that it was on that area. They might have been able to do their due diligence on it and find it, but that's digging pretty deep, pardon the pun, on that. So doing that kind of level of due diligence in advance is not always. I'm not going to be, like I said, I'm not going to get too annoyed with the client because they didn't know that. But it's in the survey and it's in the legals that delays will happen. So we need to make sure that the underwriting part of the application process is done as quickly as possible. I think so far this year, the quickest one we did was we submitted an application, which we'd done all the due diligence for, we knew it was going to get accepted, everything was absolutely fine. We submitted the full application at 9:30 in the morning. The underwriter called me at 2:15 in the afternoon to say the initial underwriting was complete and valuation had been instructed. And that's what we aim for in every single case. So sorry, I went off on a little bit of a rant there. I do apologise. But cool, I think we might have reached the end of the questions. Benice has had one last little comment on there, which I will put up on the screen, because I did a reel recently, which was all about why brokers charge fees. So she's kind enough to sort of bring this up so I can explain a little bit on this. And I guess this goes back to what I was talking about earlier about sort of specialist mortgage brokers, because I get a lot of people say, oh, well, I've got another broker and he doesn't charge me any fees. Wicked. I'm sure they're really, really awesome. But the problem is we deal with complex cases. Free brokers, they deal with non-complex cases so they can do high volume. Because if on average, and this is what the fees, the commissions that lenders pay brokers, it's not actually called a commission, it's called a procuration fee, which is essentially a fee to cover the cost of the sort of the packaging and stuff like that, is on average it's 0.35% of the loan amount. So for every £100,000 that you borrow, a broker's only getting paid 350 quid. And you imagine the time and effort that goes into most mortgage applications, unless it's really, really simple, you don't have the time to be able to do the volume of mortgage applications to allow you to actually get a half decent income. You're needing to do 10 applications a month just to get £3,500 gross, before tax that you're paying. So it's unless you're doing, really, really vanilla, really, really easy stuff, you shouldn't probably really be going to a free broker, because they're probably not going to be able to put the time and effort into your application that's needed. And some of them, unfortunately, I have heard horror stories that they just ignore you if they think it's too complicated. So you need to go to somebody that is able to put the time and effort into it, and they're going to have to charge a fee as a result of that, because unfortunately, time is money, and so they're them having the understanding and knowledge to be able to look at complex cases and put the time and effort into it, then that means that you have the you've got the right broker for that particular type of business. But what's being said, you guys are the GOAT. Without all we will get is pure declines. Yeah. Look, it's a learning process. I've been doing this for 14 years now. When I first started out, I made a ton of mistakes, and I'm incredibly sorry to all of the clients that I probably let down for the first couple of years of me being a mortgage broker, and just didn't know some of the ins and outs of the industry and the nuances and niches that I know now. I made the step into the specialist part of the market about 5 or 6 years ago because it interested me. I did my first development myself back in 2010-11. And since then, it was always going to be this part of the market that I wanted to be a part of. Having said that, chances are probably over maybe in the next couple of years, I'll look at setting up, a part of the business. Maybe it'll be Grand Union Mortgages or something like that. There perhaps will be a low fee or no fee mortgage brokerage that will be able to service the really, really simple shit. The really simple stuff, so that we can help those clients. But yeah, and until then, that it is a fee. I mean, as I'm building the team out, we'll probably be bringing in kind of new fee structures. Obviously, as my time personally is pretty precious. The clients that I deal with, I probably charge a little bit more for, because they're not just getting my time, they're getting my knowledge. They have quite high expectations of me, so I need to charge them a little bit more for that time. But as I build the team out, there will be different options for different clients that have different price brackets, and yeah, that means that they can kind of choose how much of my time they get. Do they want one of the other brokers to be their main broker with me kind of in the background supporting them, or do they want me to take on their case and be their main broker? And they're gonna if they can choose which price point they want to go with. What's that, Beth? What's Simple? Send them my way. I could do with Simple. Yeah, I've not seen Simple for quite some time. I actually had a Simple residential inquiry not so long ago. I got back to them literally within about 30 minutes of speaking to them with my recommendation, and they were like pretty impressed with that. But then they were like, "Oh, but you're charging me a fee." I mean, it was a really low value mortgage. They were like, "You're charging me a fee." And I'm like, "Yeah," like, but it's really simple. I'm like, "Yeah, but I still, my time is still precious. I need to charge for it." So they actually in the end did go to a free broker, but I'm pretty certain that they just took the illustration that I gave them and went to a free broker. But there we go. But cool. It's just like you pay for what you get. Absolutely. Guys, I am going to I'm have to jump off. I've just realized I've been on for an hour. You guys have had me for an hour today. This is the longest session we've done. Maybe it's a special because it's the 50th edition of this Q&A. So before I jump off, number one, I'm just going to say a massive thanks to everyone, because we've had a large number of people that have come on today. Some really, really awesome questions. If I haven't had a chance to answer your question, please feel free to send me a direct message, and I will definitely come back and answer that for you directly. You can also go back and stick a question in the question box in my story from earlier on today, and then I can actually share that question with everyone on my stories. So not only do you get the answer, but everyone else gets the answer as well. So thanks ever so much for coming on, guys, making this a really, really awesome episode. If you've missed any part of this will be going onto my IGTV very shortly, as well as onto my YouTube channel. If you haven't checked out my YouTube channel, by the way, guys, please go over and click the link in my bio, subscribe to the channel. New videos coming out every single week, trying to up the level of content on there, really sort of make much better quality videos with lots of really high level information in there for you on a vast variety of different things to do with property finance. There's videos in there on how to get mortgages for serviced accommodation, holiday lets, how to get what the bridging application process is, how much money can you borrow on development finance, what does a commercial to residential conversion look like from a finance perspective. There's so many videos on there, so go and check that out. Also, if you're into HMO, go and check out my new Facebook group, HMO Finance Secrets. send me a DM, I'll send you the link. Go and join that, because I'm going to be doing loads of live videos in there specifically talking about HMO mortgages and bridging finance for HMOs and all that kind of stuff. So that's a really, really awesome community. We've grown about 100 people in there already. Only launched it last week. So go and check that out, because that'll be very, very niche, very, very niche information in there. So yeah, look guys, thanks very much for joining. Go and check out all of those things. The Game of Loans podcast will be coming back in a month or so's time as well, so look out for that. If you haven't checked out any of the episodes, go and check that out. If whatever platform you listen to your podcasts on, just type in at Game of Loans, you'll be able to check out some of those. Leave me an awesome review if you can. Right, cool, I'm just rambling now. I'm going to jump off because I think the wife is probably going to want me to come down for dinner in a minute. Have a wicked week, guys. I look forward to seeing you next week on the 51st edition. So we're almost at a year of the Monday Mortgage Melt. Whatever you're doing this week, have an awesome, awesome time. And I'll catch you on the next video. See you next week. Bye.